Hello everyone, this is Rob McDougall from Zhang Financial. I'm here with your weekly economic update. Today is Monday, July 21st, 2025. So last week, of course, as we always do, we previewed all the economic data that's going to hit this week. We had suggested to you that the economy certainly looked like it was slowing, but still pretty solid. So no real fear of recession. Well, I have to say the economic data that hit last week was really, really good. So we'll go through each of these numbers, but virtually everyone was positive, was better than expected or better than feared. And a lot of it had to do with inflation. So investors very focused on inflation and when the Fed we can reasonably expect the Fed to cut interest rates. But the inflation data last week was very favorable for that. So if we do get economic slowing, and we're going to get GDP announced for the second quarter at the end of the month, July 30th, I believe. If there is slowing, this inflation data certainly gives the Fed a little bit of cover for cutting if they choose to. So we'll just start off. The inflation rate, the headline number, that was on Tuesday exactly as expected, up 0.3 month over month, over 2.7% year over year. But the core numbers better than expected. So the core was expected to be up 0.3%. It was only up 0.2%. And therefore, the year over year core was expected to be up 3%. It came in at 2.9%. So slight beat there. Great. The next day, we had PPI and core PPI. Both of those much better than expected. So the headline number PPI was expected to be 0.2% month over month for June. Came in flat. Core expected to be up 0.2%. That also was flat. So the trailing 12-month numbers for both of those better than expected. So we walked away from the Tuesday, Wednesday inflation numbers feeling pretty good. Both better than expected or feared, whatever, but very solid. Then on Thursday, initial jobless claims, and we continue to expect more pressure on labor markets. We're waiting for that uptick in unemployment claims. Didn't happen again. So the expectation was initial jobless claims on Thursday, we would see 235,000. It went the other way, actually 221,000. So that was very favorable. The same day we had retail sales and retail sales ex-auto, and those numbers both much better than expected. Retail sales for June expected to be up 0.1%, up 0.6%. And retail sales ex-auto expected to be up 0.3%, came in 0.5%. So everything really good. The next day, Friday, building permits, housing starts, both better than expected. Lastly, the Michigan Consumer Sentiment number, that was expected to come in at 61.5, and this index has been really weak the last 6 months, but expected to come in at 61.5, came in at 61.8. So across the board, that was just a really solid, really strong week of economic data that came out. So as a result of that, Federal Reserve second quarter GDP, now the books are closed, so they're just tightening things up. The expectation is 2.4% growth in the second quarter. You recall, as we keep reminding you, first quarter was weak, largely due to some disruption, some distortion due to tariffs. But first quarter was weak, negative 0.2, negative 0.3. The Atlanta Federal Reserve expects second quarter to be a positive 2.4%. Inflation expectations, now those have been rising a little bit, nothing to be concerned about. Just a couple of weeks ago, though, we were down to about 2.23. And now, fast forward a month, 6 weeks later, we're at 2.41. But again, that's still pretty good, awfully good. Again, the expectation that we would only average 2.41% inflation over the next 10 years is really good, particularly since CPI right now trailing is 2.7%. Fed funds, we do have a meeting, FOMC, next week. The announcement will be made on Wednesday. Expectation of no cut, really high. So virtually no chance they're going to cut rates, 96% built-in probabilities. By the end of the year, however, the expectation of 2 cuts, that decreased last week. Coming into the week, it was 72% probability. Ended the week at 66%. And the probability of getting 3 cuts or more by the end of the year, that drops somewhat significantly as well. Week before it was 28% probability, fell to 23% by the end of last week. So let's now review what happened in the markets last week, given the really solid economic data that we've just gone through. And the takeaway here is in U.S. markets, fixed income, equity, both okay, but no huge moves in it. So look at the U.S., the S&P 500, use that as a proxy. It was up. It was up 0.6. It's pretty good. Up 0.6%. However, equal weighted was actually down. NASDAQ was really strong. That really drove it. NASDAQ was up 1.5%. Russell 2000 up slightly. Small caps up 0.2%. So in the U.S. last week, definitely growth dominated, up 1.8%. Value actually down 0.8%. On a year-to-date basis, S&P 500 now is pretty strong. Just a few months ago it was negative, but on a year-to-date basis, S&P is up 7.8%. International, developed markets, international ex-US actually down last week. It was slight, down 14 basis points. Up still much stronger than the S&P 500 for the year-to-date, up 16.6%. The real winner last week, emerging markets, and largely driven by China, but emerging markets were up 1.6%. And in the emerging market index, China's between 25 and 30%. China up huge last week, up 3.7%. Fixed income in the U.S. Hardly moved last week. The Bloomberg U.S. Aggregate Bond Index was up only 4 basis points. Year to date, it's up a very strong 3.22%. But the 2-year yield last week was down 3 basis points. The 10 was up 1 basis point. So we'll look at the economic data that's going to hit this week, but there's hardly anything to talk about. We'll talk about corporate earnings, which we think is much more important this week versus these small data points. But we have existing home sales, initial jobless claims, as we have every week. We have new home sales. All of those not that meaningful. The initial jobless claims, though, the expectation is 228. And recall, I just mentioned moments ago, last week it came in at 221,000. So expectation still expects some pressure on that initial jobless claims. So the only economic index, 2 of them, that are coming out this week that we think might be meaningful is on Friday, durable goods, ex transportation. Why this is kind of interesting for us is it's been very volatile, particularly the durable goods orders. The headline number 2 months ago, it was down significantly. I think it was about 7%. For the month of May, it was up huge, up 16.4%. Now for the month of June, it's expected to have dropped 10.5%. Now the durable goods ex transportation, much more stable. So for the month of May, that was up 0.5%, 0.5%. For the month of June, it was expected to have been up only 0.1%. So the last thing to talk about is corporate earnings. Right now, many S&P 500 companies are reporting earnings. This is the beginning of the cycle. So through Friday, 12% of the S&P 500 had reported earnings, and 83% of them had actually beat earnings and also beat revenue. So that's a really good start. But the earnings growth now for the S&P 500 quarter to date is high 5.8, 5.9%. That may sound low. That's better than expected coming into the quarter. The expectation was 4.9. If we do end up at the 5.8, 5.9% for the second quarter, it'll be the slowest we've had since the end of this fourth quarter of 2023. In terms of the valuations on the S&P 500, this is why corporate earnings, particularly this time, this quarter, is extremely important because valuations are extended. The market's done great. To keep the market going, we definitely need to see at least stability or hopefully an improvement in corporate earnings. So the 12-month forward PE multiple on S&P 500 is now 22.2 times. So a huge premium on corporate earnings beating expectations for this quarter. And again, we're off to a good start, but it's mostly financials that have reported so far. So one thing to delve down into just for a second is in terms of the corporate earnings expectation here for the second quarter. For the second quarter, the expectation is the Magnificent Seven is definitely going to dominate earnings, up 14% or so year over year, and the other 493 in the S&P 500 up modestly, up 3.4%. So that is the case at this point, but here's something to keep an eye on if this plays out this way. Yes, Mag 7 still driving corporate earnings, S&P 500. However, the expectation consensus is Mag 7 earnings are going to decelerate over the next few quarters. And as we look into the first quarter of 2026, by the time we hit that quarter, the expectation is Mag 7 earnings growth year over year is going to be about the same as the 493. It's important to note that because Mag 7 is they've definitely driven the earnings in the second quarter and early here in the third quarter. And if these numbers are correct and the Mag 7 decelerates and the other 493 accelerates, you'll likely see some rotation away from that Mag 7, the big winners, to the other 493. So that's it for our recap and look forward for this week. We thank you very much for viewing and we hope you'll join us again next week. Thank you.